So today, the first thing we'll be looking at is certain important terminologies in this market. Okay, so we'll be looking at some terminologies in the market. All right. So we will not be looking at all the terminologies, just some important ones that I know we would be needing is what I'm going to be what I'm going to be talking about. All right, because those ones we'll be using it frequently. That is the only reason why I want us to look at them. Okay, so I think let me use trading view because I don't want to disturb this particular chart. I have some analysis and monitoring here. So let me use the trading view to teach. So now the first terminology, the reason why, okay, I have to open a new chart. I have a trade, I'm monitoring this trade, though it's almost at TP. It was a swing trade. I took some several days ago. Oh, where is this thing? So let me use a different here to do this. All right. So technology number one is trending market. All right. So those of you that are already trading, you know that um, in trading, especially those of you who take signals a lot, you hear um, your signal provider will tell you buy or sell, right? Okay. Then those of you that have gone through mentorship and co, you hear your mentor telling you about trends, bullish, bearish, longs and shorts. So today we are going to look at these terms. So that is the first part of the lesson. As I said, it's very short. Few terminologies we will look at, then we are done with that one. Then we go to the next thing, okay? All right, so the first terminology I want us to look at is trending market. So now, trending markets, we have two types. Okay, we have two types of trending markets. We have what we call the uptrend, or also known as the bullish market, and we have what we call the downtrend, also known as the bearish market. All right, so these are the two types of what trending market we have. So when we talk about trending markets, we are looking at a market that has a specific direction. Okay, it's having a specific direction. It is either moving up or is moving what down. Okay, so that is what that is a trending market. That is a trending market. Now the two types, as I said, is what the uptrend or upward movement, also known as the bullish market, and then the downward or the downtrend, also known as the bearish market. So let's look at what the bullish market is. So just follow from here. So when we talk about bullish market, we are looking at a market that is trending upward. Okay, that is moving upward. All right. So uh, let me use this to demonstrate. So a market that is forming this kind of what structure is referred to as what as a bullish market or an uptrend or an upward movement. So based on even this illustration here, you can see that the movement over here below the illustration is what is a bullish movement currently on vol 25. Okay, on VIX 25 we are having what we call the bullish what trend. Are you guys with me? Please, I hope everybody is hearing me loud and clear. If you are hearing me very clear, type
Yes, sir.
yes in the chat. All right, so let's move on. So this here, as we can see, is what is a this is a bullish movement. Let me use the arrow to show you. So this market is moving upward. All right, this market is moving upward. That's why we refer to it as what a bullish market or an uptrend. So in the course of the lessons, when I begin to say we are going to first determine trend to know whether the market is moving in an uptrend, then that means I'm saying we are looking for a market which is moving in this specific kind of what of way. So that is about an uptrend. Now a downtrend is a reverse of an uptrend. Okay, what I mean about that is in downtrend the market is moving on downwards. Okay, this market is also known as the bearish market. The bearish market. So with respect to the bearish market, you see some kind of movement like this. All right, where we have series of lower highs and lower lows forming in the market. So when we begin to look at basic market structure, I'll redefine these things properly under basic market structure. All right. So an example from the chart is this movement we are seeing here. As you can see that from this session here, market was moving in what? In a downward manner. Okay, it was forming series of lower highs and lower lows. So you can see that if I move this drawing from the chart, you can see it's in similarity to the demonstration I made here. So that is how a bearish market looks like. Okay, all right. So now let's look at the next terminology, that is longing the market. Okay, or to long in the market and to short in the market. So now when somebody tells you long, go long on a certain asset, on a certain pair, on a certain currency pair. So for instance, let's say someone tells you long USD JPY. What the person is trying to tell you is that you should what? You should buy the pair called USD JPY. Okay, so longing a market means to buy that market. So another term for buy in the trading arena is what? Long. Okay, so once you hear the word long, it means they are telling you to what? To buy in the market. I know a lot of you will find it boring, especially those of you who already have the knowledge. But one thing I believe in trading is if you want to learn a new thing, you have to unlearn the old thing. And it's not just even in trading, it's in all aspects of business. I myself, I do that every time I want to upgrade myself. I make my mind as though I've not learned this before. That is the only way you will be able to capture the concept that this new person is giving you. But if you want to be comparing what he or she is teaching to what you have already learned, you end up confusing yourself. So please, I know most of us have learned it, but the purpose for this whole thing is for even newbies to be able to what? To trade. That is why we are starting everything from scratch. So bear with us. We will soon be done with this boring theory, quote unquote, topics. Now, when we say short, when I say short the market, okay, so when I say short the market, that means I'm telling you to do what? To sell, okay. If I say you should short the market, I'm telling you to what? To sell. That means we are looking at what? Downward movement. We are expecting price to go. So when somebody says short GBP USD, it means the person is telling you to sell GBP USD. Or short Euro USD, it means the person is telling you to sell Euro USD. So please take note of that. So the next terminologies we are going to look at is the bulls and the bears. The bulls and the bears. Okay. Now when we talk about bulls, we are looking at traders who are longing or buying a certain currency pair. Okay. If I say this group of traders are bulls, I mean I'm referring to them as the animal bull. No. All I'm just describing describing them as in the market, people who are longing the market at that time, people who are causing, oh sorry, people who are causing um people who are causing the market to move in this nature, that is to form series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows in the market. Okay, people who are long in the market are the people we refer to as the bulls. All right. Now, when we talk about the bears, okay, then we are looking at people who are shorting the market. Those who are selling in the market are referred to as the bears. Okay, people who are selling the market are referred to as the bears. Okay, so someone who shorts, okay, someone who causes the market to move in this pattern, all right, is referred to as what? As a bear. All right. Now, the next terminology we look at is the ranging market. Okay, so this is another type of market. We look at the trending market, which is made up of two. That is the bullish market and the bearish market. Now we are looking at the next type of market, the ranging market. Now, when we look at ranging market, let me put the demonstration here so that you see what I mean. When we talk about the ranging market, we are looking at the market that is moving between what? Two boundaries. That is how I call it, or that is how I refer to it. It's moving between what? Two boundaries. Now, these boundaries are not equal lines, straight, single straight lines as I've drawn here. It could be um, a zone. They are mostly zones. They are not just single lines. So sometimes you see movement even beyond the boundaries. Okay, like this. Sometimes you can see fake outs like this beyond the boundaries because they are zones. All right, but then you see that this whole thing is happening between 2 points. Okay, two obvious points which I was referring to as what? As boundaries. Okay, so these straight lines here are the 2 points I'm talking about. So the upper boundary and then the lower boundary. All right. Now, if we want to use it as zone, we can use the rectangular box and draw our zone, which means anytime price enters into that area, okay, depending on where price is, if it is at the lower boundary here, which is a term we will be looking at very soon called the support point, then we are looking to buy in that market. Now, if it is at the upper boundary here, which a term referred to as resistance, is known as resistance, then we are looking to short the market. But it doesn't mean that once price does get there, you short the market. No, you have to look at certain confirmation, which we'll be talking about as we move on. Okay, we'll be talking about them as we move on. So please, let's just be patient, get the concepts right before we dive into anything else. All right, I'm going to even teach you very simple way you can trade just support and resistance, and you make crazy money with it. Like, I'm being serious here, though I'm not a fan of trading support and resistance, but there's a very fine way you can use SMC concept to trade support and resistance, and no one will even know you are trading support and resistance. Being very honest here with you. And when we get there, you just see, you just like it, because it's something that you need to see. Once it is, you see it being obvious, Charlie, you go into the market, you milk what you want to milk, and you come out. All right, so I'm just dangering you. So let's go to the next thing. So I'll not delete this drawing because you will still use it. So let's go to the next point, and that is the support and the resistance. Okay, so let me label them here. So this side is the resistance. All right, this is the resistance. Then we have the support down here, the support. All right, now let me use some simple scenario or terminology to explain this support and resistance thing to you. Okay, sir, can you go over the ranging market? All right, so no problem, I can go, because even the support and resistance has to do with it, so I will explain everything together again. Let me just talk about the support and resistance, then I come back and explain the ranging market. All right, so when we are looking at this resistance level, okay, now this resistance level is mostly a price level, okay, that is so strong to the extent that it reverses an upward movement. So you can see that here price was moving upward, but once it hit onto this resistance level, price reversed and begin to move downwards. All right, price reversed and begin to move what? Downwards. All right, now when we talk about support, this brings us to what? Support. When we talk about support, this is also a price level where buying is so strong that a market that is moving downwards is being what? Interrupted by demand, or is being interrupted by what? The buyers. Please, once you join, mute yourself. Once you join, please mute yourself. All right, so here at support, once price gets down there, price is being interrupted. Okay, by, Gifty, please mute yourself. Price is being interrupted by buyers. Then price is then reversed. Price is then reversed. Okay, so that is one thing. So now the person said I should re-explain the range. Now that you know what support and resistance is, it is going to be easier for you to understand what ranging market is. So ranging market is kind of a market that moves between two horizontal points. I'll come to another type of ranging market. Okay, we have what we call dynamic ranging markets, where we have the dynamic support and resistance. All right, but this is the horizontal or the static support and what? Resistance. With dynamic support and resistance, price changes as we move in the trend. So the dynamic support and resistance, the dynamic range occurs in a trend, but the static range is where price begin to reverse at a static price point, all right, or price range. Okay, so here you can see we have the 2 points, this point, so the resistance point and the range point. Now market begins to move up down, forming highs, low, low high, higher highs, higher lows, higher highs, higher lows. But once it meets this resistance force, a force that is so powerful to reverse a a movement upward. So resistance is just like the ceiling in your room. Okay, so when you are in your room and you raise your head, you see the ceiling. Now if you jump, because of the ceiling, you will not be able to jump out of your room. Then support is just like the floor where you step in your room. Because of the floor, you will not be able to fall and go beneath the ground in your room. You are static at the point where your floor is. All right, so that is how support and resistance work. And then range is the movement of price between these 2 points. All right, so instead of maybe just drawing one thing like this for you as the range, I use this movement because that is the realistic price movement on the chart. Price is not just a single line up down like you see in most books. All right, price moves in what? In a dynamic way. Okay, so please take note of that. The person who asked the question, please, are you clear now, so that I can move on to explain the dynamic. um all right, thank you, Festus. So now let's look at the dynamic support and resistance. Let's look at dynamic. This is the static, so I'll just shift the chart and then, all right. So with the dynamic, we have something like this. So that is our dynamic resistance, and then our dynamic support. All right. So here this time, price is moving, forming higher high, higher low, higher high, higher low, higher high, higher low, higher high. But this time it is forming this between these 2 points. All right. So if you trade chart pattern, dynamic support and resistance helps you to what? To be able to locate different types of what? Chart patterns ranging from rising channel, flags, um, falling wedge, rising wedge, um, symmetric triangles, and a whole lot. Okay, is the dynamic support and resistance that causes you to get the formation of these patterns. So if you understand how dynamic support and resistance work, then trading chart patterns is kind of easy if you can apply the other concepts from Emmanuel. Please mute yourself. Emmanuel, please mute yourself. So if you can understand these concepts, then you should be able to what? To understand how chart patterns are formed. So this is kind of a ranging market in an uptrend, okay? And as time goes on, you understand what this resistance is doing and what this resistance is also doing. We refer to them as liquidity. What type of liquidity are they? We will look at that once we get to liquidity. So we can have them also forming in the downward move, where we have the lower highs and the lower low, lower high, lower low, lower high, lower low forming in the market. Okay, so if you join your trend line, you what? You can connect your trend line both up and down, and this gives you what? A channel. All right, a channel. So this is how dynamic support and resistance work, and this gives us what we call a dynamic range, a range that is formed at different price levels in a trend. All right. Okay, so the next thing we will look at is the bid price. The bid price. The bid price. Very, very important. The bid price. So when we talk about the bid price, we are looking at what? The price at which you the price at which you want to what? To sell an asset. Okay, so the bid price is the price at which you want to what? To sell an asset, being it a currency, metal, a synthetic asset, whichever asset it is. The price at which you are willing to sell it is referred to as the bid price. Then we have what we call the ask price. Okay, so now the ask price is the price at which you are buying an asset. Okay, the lowest price, the most discount price at which you are buying an asset is referred to as the ask price. But now let me show you something. In actual fact, we are supposed to be what? To be buying at the bid price and not the ask price, and be selling at the what? At the ask price and not the bid price. But the reason why we are buying at the bid price instead of the ask price is that the broker now is the intermediate between us and the central market. Okay, so the broker charges a fee, and because of that fee, the broker gets the offer, that is the what? The buying price at the actual ask price from the market, and then sells it to you at the bid price that he is supposed to be sorry, at the ask price that he is supposed to be selling. So he is selling to you at the actual ask price and you are buying from there. So you are buying high from him because he is making a commission after buying from the main market. All right. Then when he is buying from you, instead of buying from you at an ask price, he will be buying from you at the bid price. All right. So let me explain what I mean using let me share the other chart. So this is a ranging market. You see here where I drew this price is ranging between these 2 points before it broke out. All right. So that is a ranging market. I think somebody was asking a question. Please, I'm coming. I wanted to show you guys something. All right. So if you see here, see where they wrote the sell. Okay. The broker is telling you to sell to him at this price. This is supposed to be what we call the ask price. All right. So instead of you selling at the ask price, are you okay? You are rather going to be what? To be buying at the what? At the bid price. Sorry, at the ask price. Sorry. Instead of you selling at the what? At the ask price, you'll be what? You'll be buying from them at the ask price, which is this. And instead of you buying at the what? At the bid price, you rather be what? You rather be selling to them at the bid price, which is this, the first button on the left. Okay, that is the bid price, and this is the ask price. Instead of you rather what buying here, you rather be buying here at high. If you watch, you see that the price here, if you subtract the differences, that gives you the what we call the spread, which is the next terminology, the spread. And the spread is the charge which the broker is charging you for taking trades using its platform. So the spread is the charge. Okay, so this is the difference between the bid price and the ask price. The spread is the difference between the bid price and the ask price. Yeah, somebody was asking a question. Let me check. Okay, somebody said the ask price. So I was saying the ask price is the price at which you buy an asset. Okay, where you click here like this buy, that is the ask price, and when you click sell, that is that is the bid price. But in actual fact, we were supposed to be buying at the bid and selling at the ask. But I explain why it is not so. The reason being that the broker is an intermediate and they also need to make commission. So they buy at the at the bid price, the actual bid price, and sell to us at the ask price. And the difference between the bid price and the ask price becomes their commission, which we refer to as the spread. So that is link up junior. Do you understand? If you understand, just type it in the chat. All right. So now let's look at how to calculate the spread. It's simple. You just subtract the bid price from the ask price. The difference is your spread. Okay, the amount the broker is charging. Now, different assets have different ways of calculating the pips. Okay, that is the money. All right. So when it comes to indices, we calculate them in uh, points. Calculate currencies in pips. Um, Synthetics is also calculated in points. Okay, so it moves as well. So though people are used to saying pips, me is correct. All right, pips, points is correct. Okay, but people sometimes decide to differentiate between them. All right, so pips is the unit of measurement used to express the change in value between two currencies. So when you take the change in value between two currencies or two assets, that is what we refer to as the pips. All right. Now, you look at other terminologies as we move on in the lectures. Okay, for them I'll be mentioning them during the lectures, maybe you understand before we move on. So this brings us to the end of lesson 4.